Time for business, and we're starting off in the US today. The government's still trying to get compensation. This is for the behaviour of banks in the run-up to the financial crisis. Will's got more.
That's right, it's JP Morgan that's under fire actually, and it's for activities undertaken by Bear Stearns. If you remember that name, that was the bank which got into real trouble at the height of the 2008 financial crisis and was taken over by JP Morgan. Now, the US government says that the Bear Stearns itself committed multiple fraudulent and deceptive acts in promoting and selling what are known as mortgage-based securities. Now, those are, of course, those packages of financial products made up mainly of subprime mortgages. They were in the financial crisis, and essentially the New York Attorney General has been saying they were missold by Bear Stearns. Now, JP Morgan is the bank that is currently under fire for that because they bought Bear Stearns, and they're saying that's slightly unfair because, of course, at the height of the financial crisis, they were not forced to buy the ailing bank, but they were put under heavy pressure by the federal government, and the decision to buy Bear Stearns was made just over the course of a weekend, and not usually how you'd buy a bank, obviously. So they're feeling a bit hard done by having sort of helped out the government in this regard, now coming under investigation. Also, of course, it is rather political with these elections coming up in November. You might think that this could have been sorted out earlier on in Obama's presidency, but it's only just been sorted out a month before the elections.
OK, back over to the Eurozone. Greece, got to mention that one, of course. Things not getting much better.
I'm afraid to say they're certainly not. They've unveiled their draft budget for 2013. Even more cuts are on the way, and the country seems to be headed for its 7th successive year of recession.
Shouting Troika out, angry protesters greet inspectors from the International Monetary Fund, European Commission and European Central Bank. The international creditors returned to Athens on Monday for crucial talks with the Greek government. They discussed a revised proposal of austerity measures needed to unlock a 31.5 billion euro installment from a 130 billion euro second bailout. The Troika is reportedly worried Greece won't be able to deliver part of the deal.
The international lenders have asked for more details. Consultations are continuing.
The Troika's visit comes as Greece unveiled a draconian draft budget on Monday. The government pulled no punches, announcing it will slash spending on pensions, salaries and healthcare. Savings worth 7.8 billion euros this year, that's part of an 11.5 billion euro package of savings agreed with international creditors spread out over the next 2 years. The draft budget forecasts that the economy will shrink by 3.8% in 2013, on top of a 6.5% contraction this year. It will be Greece's 6th straight year of recession, meaning economic output will have declined by a quarter since 2008. The draft budget must now be passed by the Greek government.
So that's Greece, now to Spain.
Yep, the Reuters news agency is reporting, quoting unnamed sources, that Spain could ask for a bailout as soon as the weekend. Now, apparently Germany is trying to get them to hold off because, of course, it is a problem for Germany passing these bailout resolutions through Parliament. Parliamentarians are getting more and more against giving out money the way they see it to all these insolvent countries around the Eurozone, and Germany wanting to put that off a little longer, if at all possible. However, Olli Rehn, the EU's finance commissioner, has been in Madrid on Monday. Who knows? Was he talking about a bailout? Well, I'm sure we'll find out, perhaps. But for now, he's insisting that the EU does have enough money and is ready to provide a bailout if one were needed.
OK, dangerous times as ever then. What about the markets? How are they taking it all?
Well, actually, they've rather factored in the Eurozone crisis for now, at least. The US markets closed broadly up, except for the Nasdaq on Monday. There was a surprise improvement in manufacturing activity, so that cheered things up a little bit. And things are broadly positive in Asia as well, in fact, helped along by the Australian Central Bank. They have cut interest rates for the 3rd time in 6 months due to worries of a slowdown, but that has, as you can see, certainly pushed up the ASX in Sydney.
OK, now we've got some signs, real signs, in fact, that sanctions are finally having an effect on Iran's economy.
Yes, the rial, the Iranian currency, dropped to a record low against the dollar on Monday. In fact, it's been down by 28% against the dollar in the last week alone. Now, this is being taken as a sign that it's running out of currency, perhaps. It's unknown exactly how much currency reserves Iran has, but it can't be helped by the fact that there are, of course, oil sanctions due to Iran's nuclear program, and oil is its main revenue. Last week, it did try and set up a special government-run exchange so that key goods could be bought in dollars for a cheaper rate, but that seems to have only reduced confidence further.
Okay, well, next, something we mentioned in the news is Paris Fashion Week on at the moment here in Paris, and the big fashion houses looking to China to boost their bottom lines. While business has become more challenging here in Europe, French labels are trying to develop their operations in Asia.
With the debt crisis raging in Europe, many French firms are looking to expand their business in China. The fashion industry is no exception. Asia is among our priorities. It's a crucial market for fashion. According to the Boston Consulting Group, China's fashion market is expected to triple over the next decade. It's forecast to hit 160 billion euros in 2020. But it doesn't mean selling luxury goods to Chinese customers is always easy. Chinese shoppers are seen to have become more sophisticated. Today, they're not just looking for the big brands, they want something unique.
They like something personality, the same simple style, but with the accessory or details very special. So I think some brand like Caravan, they are a big match in China.
A trend that may give a chance to smaller French labels in China, but also push bigger firms to be more adventurous and creative.
Some interesting outfits there anyway, weren't they? Now finally, IKEA come in for some criticism for a rather glaring admission in one of their brochures.
Yeah, what they missed out in their Saudi Arabia edition of their catalogue is women. As you can see, there.
Bop, off she goes.
She goes, she's disappeared. The one in the middle, keep an eye on it. Oh,
Bop.
There she's gone. Of course, in Saudi Arabia, women aren't allowed to travel or study without male permission, and aren't allowed to drive, of course. And so, presumably, this was to avoid offending cultural sensibilities. But the company has since taken on board criticism in the West, saying the exclusion of women does not align with IKEA group values. So we can maybe expect to see that changed.
Yeah, lucky we're both blokes, otherwise the news would be a little bit shorter this morning here on France Market. But Claire's here next, she's not popping off, she'll have the bulletin after the break. Stay with us if you can.